Lululemon stock looks pretty juicy here. If this is your first time watching, my name is Daniel. You're watching Unrivaled Investing. Oftentimes, when I come across a stock, I do the thumbs down or not quite sure about it. But occasionally, the rare rock where you turn it over and you go, this actually looks pretty good. This is one of those videos where I think Lululemon at the current price looks pretty interesting. As always, it's not financial advice, but looking at the stock price and what's gone on, this does intrigue me. I personally do not own Lululemon stock yet. I might change that in the future. I'll let my subscribers at unrivaledinvesting.com know if and when I do make that purchase. But broadly looking at Lulu, it would not surprise me if it outperforms the broader US indices in the future or broader stock market indices over, let's say, the next 5 years. Let's dive into understanding why or what's been going on, sort of high level, what's going on with Lululemon LULU stock. Is this potentially the bottom? I did a previous video on Lulu just a few months ago asking whether or not it was on sale. And while I determined that they were likely winning market share from some of the mega brands, such as Nike or Under Armour, I just wasn't excited about the valuation. I was asking myself, does 29 times earnings really make sense? Is that really that compelling? And my conclusion was, not really. There are better bargains to be had. And subsequently, the stock has continued to come under pressure, losing around half of its value in just the last few months. And so this is now entering a territory where I go, this does smell interesting. This does look good. Let's understand the fundamentals. You always want to separate out the different pieces. You have price action, which is an important indicator, but I'd argue more important is for you to suss out the fundamentals. And when you look at the fundamentals of Lululemon, you see revenue growing 10%, earnings growing more than 10%, comparable store sales growing 7%. These are all very reasonable figures, suggesting that they're growing in line with the industry or even slightly better. Looking, you want to just keep diving in. When you come across something that's interesting, let's just keep pulling apart the layers, until you come across something that you don't like. And so looking at their financials in greater detail, I see, once again, that revenue figure that I like. Margins were actually slightly improved year over year on a gross margin perspective. Looking at their costs did tick up a little bit, which looks like this is broad-based investing in the business, which did hurt their underlying operating profitability, but not by a huge degree. 20.1% versus 19.6%. Still, given their underlying growth, they were able to post very solid earnings per share growth, and they're using their free cash flow to buy back shares. You can see the diluted share count declining year over year. So I'm really liking a lot of their results. Zooming out a bit, I mean, look, this business historically crushed it, taking significant market share. And now there was a lot of volatility, in response to COVID and people buying things that were comfortable and then changes in consumer behavior. But broadly looking at this, I mean, this company has done quite well over time. You can see how their revenue has gone from just a few $billions to close to $10 billion. And then this year, this is including Wall Street expectations, which is slightly above management's guidance. They're expecting, a little shy of $11 billion in revenue and, high teens earnings per share growth. These are very, compelling figures. You can see all these, fundamentals as well, along with Wall Street estimates at AI Ticker Chat. And so I want to understand, why might the stock be lower on these results? Looking at the fundamentals, why would the stock be lower when broadly I'm seeing things that are pretty good? So I select their earnings transcript because I want to, understand maybe it's something management said that's concerning. And so they talked about having some sort of markdown, an inventory markdown that increased by 50 basis points, so 0.5%. So that could be concerning. Maybe they have to go through their inventory, say some of their stuff isn't selling as well, maybe an execution issue. They talked about U.S. market performance, relatively modest, only 2% increase. That does suggest that they're potentially losing market share in the U.S. We'll talk more about that in a second. But that is a red flag for investors, as the AI is calling out here. And then also maybe it's a competitive landscape aspect. Maybe there are heightened or increased competitors that's causing this initial impact with the US. And then if it starts with the US, decelerating significantly, maybe it expands to the world over time. And that creates challenges for Lulu. So I think broadly, I understand some of the key concerns that investors might have, sort of asking why might the stock be down based on these results. But looking at their actual results, once again, you want to check, reality versus what the concerns might be. And the reality is, like, looking at this business, men's revenue grew 15% in the most recent quarter. This is one of their key initiatives, and that suggests they are actively taking share in various different men's products. So that does reflect that their product innovation is working well, at least for the men's demographic. Looking at market expansion, international growing 35%. This is in large part led by China, but also growing around the world. This 35% growth suggests they are crushing it, that they are taking market share. So I look at these things and I'm thinking to myself, this is actually, this suggests they're winning share. This suggests they're doing quite well. So I'm sort of thinking like, this looks pretty good. All right, so let's think about the valuation and let's think more about the market share aspects, the risks that they could be losing it maybe to some niche players. First of all, this is not financial advice. At the time of this video publication, I did not own Lulu stock yet. I might change that in the future. And also, quick plug, recently a premium member of the Unrivaled Investing community shared the following. This is a direct quote. I got introduced to the markets as a speculator during the 2020-2021 bubble. Your content really helped me understand long-term investing. Most of the online friends I made during the bubble are still speculating. I'm trying to convince them to join your membership. The unrealized profits from, and it mentions a couple of different companies, is enough to cover 302 years of membership. I'm really glad to hear that. It's a community designed not only to share compelling ideas, but also share, educational tidbits that I've learned personally along the way that might be helpful. Looking at Lulu, going from Unrivaled Investing, my community, to Lulu, I do like to see this buying. I do like to see that there was an insider, a director, buying over $1 million worth of stock. So that is a favorable development. It's not a lot, but it's not a lot relative to, let's say, some of these other insiders selling stock significantly, but it is an indication of, hey, there might be value here. A red flag that is worthwhile for investors to reflect on is that there are these smaller niche leggings and athleisure brands, Alo Yoga, I don't even know how to pronounce this, Viore, which might be nipping at the heels of Lululemon. And there are some reports, and this is one from April, suggesting that they might be taking market share and that they have shoppers that overlap with Lululemon and Nike. I look at Nike's results and Nike's clearly losing market share, broad-based. Lululemon's US deceleration could suggest a red flag. So we're going to want to see what management has said about this. So this is potentially an issue. These smaller players, sort of disrupting Lulu's core North America business, and could this, roll out internationally over time? So that's something for investors to think about. When I look at, Google search trends, I typing in the various different brands like Lululemon, Athleta, Alo, Fabletics, Viore. Clearly, there's a lot of different athleisure brands out there, but it's very clear that Lululemon over the past year was the dominant player. And during this time where investors were concerned about it, because really this is going through their first quarter results, you could see there was this uptick in Alo. So maybe Alo is eating their lunch a little bit, at the margins. Looking at these other players, though, it really doesn't seem like that's really trending at all relative to Lululemon. And it's also possible that Alo, because it can overlap with the term aloe vera. That's I think it's a plant that you can apply if you have like a burn wound or something. So they might be benefiting from that here in terms of their search trend. So it's not exactly an apples to apples, but broadly I look at this and it does appear that Lululemon is just an unrivaled brand. I mean, that is an important data point to reflect on, is that they've built a brand that consumers like. Many consumers love the brand. They're clearly winning market share with men's and international. Those are huge green flags. There's just this question of like, are you losing share in the US to some of these niche players? So that's, once again, let's see what management has to say about this. Once again, leveraging AI ticker chat, asking it like, hey, what's management, what have they said about, potentially losing market share or the competitive landscape. I'm selecting the most recent transcripts. And so management doesn't think that they're losing market share or facing significantly tougher competition. They talk about how the competition landscape hasn't dramatically shifted in the most recent quarters, but they do highlight that they've had internal missteps. And so they talked about how their color palette was too narrow and that they faced stock issues, so they didn't have enough inventory in smaller sizes. So in other words, more petite users, maybe benefiting from that GLP, drugs, they're like, hey, we need smaller sizes, and you ran out. So maybe that's an issue that hurt their growth. They did talk about, look, this is an internal execution rather than losing ground to competitors. It's not competitive impact. So based on what's management said, and especially seeing the revenue growth with men's, 15% growth is very solid. It does suggest that they just had some real missteps with women's wear. I don't have a lot of experience with women's wear personally. So for the viewers that do, would love to hear it, especially if there's any, women that are tuning in. I see based on Google Trends that it's a very, it's a small percentage of the users on this channel, but I'd love to hear your commentary, if you're enjoying, your Lulu, because this is honestly, like, let me say this. I once heard in the last few years from a friend that, he talked about how he did really well in the stock and he uses this filter. And I'm going to share this filter because I think it's a golden nugget for you. Whereas he said that he looks for companies that Wall Street hates, but the consumer loves it. And when you have that dynamic going on, it's a great setup because eventually, if the consumers still love it, eventually Wall Street will love it too. And I'm thinking that's what you're looking at here with Lulu, is you're looking at a company that ultimately consumers love. And they had some missteps with execution, not enough inventory, not the right color palette. Overall, though, these seem like survivable problems. Now, if they keep having execution issues, then it turns into a management issue and then a bigger problem, and then you have a lower valuation. But broadly, I look at this and I'm thinking this is a one-time, Warren Buffett loved to call another golden nugget. Warren Buffett talked about find the great businesses that have a one-time solvable problem and buy them when they're on sale, because Wall Street is overly focused on myopic concerns versus looking at the longer term. And I'd say longer term, this brand I don't think has been impaired. I can be wrong. I'm not a specialist on athleisure wear, but so far these data points do suggest that it's still a very strong, if not unrivaled brand. There are some smaller companies biting at their heels, but this does look like that type of Warren Buffett of find that strong brand. Yes, it's retail, which you don't want to, Buffett would also say like, hey, retail's insanely hard. So I broadly look at this and say, this is why I think it's so interesting. When I run it through the numbers, once again, leveraging AI Ticker Chat to think about, where could the stock be in the coming years? This is asking AI to say, hey, come up with a figure for sales growth, profit margins, and multiple in the years ahead. And it's very optimistic, or it's very positive, I should say, saying, look, if you continue to have teens growth and some margin expansion and, Wall Street wakes up again, moving from, let's say, a high teens earnings multiple to 35 times, then you're talking about, nearly 300% upside plus the free cash flow that the business generates. Keep in mind, it's generating around $1.5 billion of free cash flow. Maybe that increases over time. So that's a 4 or 5% yield that could be going to shareholders. That's buying back stock. That's a tailwind for investors. I personally, I'm going to tweak the assumptions to be a little more conservative, say 5 to 10%, 21 to 23%. This is using the AI predict feature. And, so AI gave the initial estimates based on reading transcripts and, thinking what it knows about athleisure and these various trends. But this is my own more conservative take, saying like 21 to 23%. So that's a little bit of a tighter range in terms of their margins, a lower revenue growth outlook, and also just a more conservative multiple in the next few years. But still, this is broadly, I'd argue, attractive, where or a situation where I think it could outperform the broader market because, in this more More conservative scenario, it's up over 100%. And in a super conservative scenario saying, hey, you're only growing 5%, margins decline, and the multiple effectively stays the same, you effectively break even, and that's before the free cash flow that you're getting. So I like this setup. I like it when you can say, hey, if you have really poor execution, maybe you break even, or in depending on the assumptions you use, maybe it's 50% higher. And then if they really execute and they crush it and market the valuation resets, then it goes much higher. So I look at this. I like the setup. I haven't pulled the trigger yet. I'm still thinking about it. Would love to hear some input from some of the community, the comments below. But overall, seems very reasonable. The one aspect that I think it's important for investors to reflect on is that this can all be for nothing. This can all be wrong if the wild card plays. And the wild card, I'd argue, is if there's a recession. And if there's a recession, then it's like, oh boy, because then the consumer's weak, and then margins take a hit, and then you have increased inventory write-offs. So that is you're playing this game, and long term it'll probably work out, but it is important to recognize that if that recession card does get pulled, there's like a game that I play called Taco versus Burrito, and it's a disgusting game with children like it, and so you're trying to put things in people's burritos and build up the burrito, but like you can get this health inspector card and it wipes out your burrito, and you're like, oh, like I lost the game all of a sudden. That's sort of how this works, is like health inspector, recession card. If that gets pulled, then you get this situation where, like, look, in 2009, Starbucks traded at 8 times free cash flow. You could have something like that happen with Lulu. So any investor that's buying now needs to have that in the back of their mind, because I think you need a strategy of like, hey, you might get punched in the face, and what's your strategy at that point? If there's no recession and things work out well and they have solid execution, would not surprise me at all if Lulu does really well from here. Personally, with my own investment journey, I am considering the fact that I think the chances of a recession are elevated. And so, like, for example, in my most recent letter, which came out yesterday, I called out like, hey, here are 3 different companies that should create value even if there's a recession. That should, their business is historically very robust. So, that's a lens that I'm personally considering for my own personal investment journey, but every investor is different. I hope this video has been helpful for you. Thanks so much for tuning into Unrivaled Investing.